In this video, we are about to reveal the secret weapon of smart investors, dividend-paying stocks that stuff your pockets every single week. Sounds like a dream, right? Well, with the right strategy, it can be your reality. So without much ado, let's get into it. Imagine you're getting into the world of investing, looking for a steady stream of income that rolls in like clockwork. You stumble upon two companies, each with its tale about dividends, those sweet payouts that companies hand out to shareholders. Take Company A stalwart in the utility sector. Its stock is trading at $50 a pop, and every year, like clockwork, it dishes out $2 per share in dividends. That's a solid 4% return on your investment, just from those dividends alone. Then there's Company B, buzzing in the tech sector. Its stock price is higher at $100 per share, but it pays out a slimmer $1 per share annually. That's a 1% dividend yield, still something to consider, especially if you believe in the company's growth prospects. Now, why should you care about dividend stocks? Well, here's the deal. These stocks aren't just about hoping for a higher share price someday. They're about getting paid regularly, like a paycheck from your investments. See, dividend stocks can be your ticket to a reliable income stream. They're like planting seeds that grow into money trees, paying you out season after season. Whether you're planning for retirement or just want some extra cash flow, dividend stocks can be a savvy move. Now meet Alex, a savvy investor riding the weekly dividend wave for the past year. He started with a modest investment in Realty Income Corporation, affectionately known as the Monthly Dividend Company. Despite its nickname, Realty Income actually pays dividends monthly, which Alex receives like clockwork. But by diversifying his portfolio with a few other weekly players, he's created a steady stream of income that hits his account every week. Now you might be thinking, hold up, weekly dividends? Is that even a thing? You bet it is, and it's a game changer for folks looking to generate consistent income from their investments. While most dividend-paying stocks dish out their payments quarterly, there's a select group of companies that have embraced the weekly model, and they're gaining quite a following among income-hungry investors. So why should you care about weekly dividend stocks? Well, for starters, they can provide a more stable and predictable cash flow. Instead of waiting 3 months between payouts, you get a little boost to your bank account every week. It's like having a part-time job that doesn't require you to clock in. Your money works for you around the clock. Moreover, dividend-paying companies are more mature and stable, often operating in sectors like utilities, consumer staples, or telecommunications. But remember, it's not all rainbows and unicorns. There are risks too. Companies can cut their dividends if times get tough or if their earnings falter. And let's not forget, dividend stocks can dance to the beat of interest rates. When rates rise, dividend stocks might lose their shine compared to bonds or other investments. So, should you dive into dividend stocks? Well, that depends on your goals and your risk appetite. They can be a reliable source of income and even offer the potential for growth. But like any investment, it pays to do your homework. Look for companies with a history of stable earnings and a commitment to paying dividends, even when the going gets tough. Let's break down some of the top weekly dividend payers that could pad your wallet regularly. Number 6. Sabine Royalty Trust. Sabine Royalty Trust operates like a financial middleman. It gets paid by Sabine Corporation for owning a bunch of cool stuff, like landowners' royalties, mineral rights, and other interests in oil and gas properties spread across 6 states: Florida, Louisiana, Mississippi, New Mexico, Oklahoma, and Texas. These properties are the trust's main assets, along with some cash they keep handy for expenses and paying out to investors. Argent Trust Company, based in Tennessee, manages all this financial juggling as the trustee. They ensure everything runs smoothly, from collecting royalty payments to handling the trust's financial business. Now let's talk numbers. Sabine Royalty Trust has a market cap of about $944.159 million, which tells you how much the whole operation is worth on the market. There are 14.58 million shares of the trust out there. On average, about 0.03 million shares have been traded over the past 10 days. Here's the juicy part for investors. The trust pays out a dividend of $6.12 per share. That's a sweet deal because it gives investors an excellent return on their investment, specifically a hefty 9.46% dividend yield. So if you're looking for a steady income stream from oil and gas without getting your hands dirty, Sabine Royalty Trust might be right up your alley. Number 5. Gladstone Commercial Corporation. Here's another gem for dividend-seeking investors. Gladstone Commercial Corporation, trading under the GOD, boasts an impressive 10.5% dividend yield. This company operates as a real estate investment trust, REIT, managing a vast portfolio of properties across 28 states in the U.S. They've got a hefty 15 million square feet under their belt, spread across 122 properties. About half of these properties are offices, with industrial, retail, and medical offices comprising the rest. Despite the current woes in the office property market, Gladstone Commercial shows resilience. More than half of their tenants come from 19 industries, ensuring a diversified revenue stream. Vacancy rates might be problematic for offices, but other property types remain robust. The company maintains an impressive 96% occupancy rate, and with an average lease term of 7.5 years, its cash flow looks stable. Last year, the REIT saw a 25% drop in share value due to rising interest rates. However, insiders, including the CFO, have recently shown faith in the company by purchasing additional shares totaling $90,000. This move signals confidence in a potential turnaround, especially if the Fed decides to cut interest rates next year. Regarding dividends, Gladstone Commercial cut its dividend earlier this year to safeguard cash flow amidst market uncertainties. However, it's managed to keep payouts stable, maintaining a solid double-digit yield. Historically, the company goes ex-dividend in the third week of each month, making it a predictable income source for investors. Number 4. Delic Logistics Partners. Here's another gem for dividend seekers. Delic Logistic Partners LP, known as DKL on the market. This company plays a crucial role in the energy sector, focusing on moving and storing oil and its products. With a hefty dividend yield of 10.25%, it's a solid choice for those looking to add reliable income to their portfolio. DKL doesn't just deal in oil logistics, it also handles natural gas processing and water management for Delic Holdings' refining operations across Texas and Arkansas. It means they're deeply integrated into the energy supply chain, providing essential services always in demand. Regarding financials, DKL boasts a market capitalization of approximately $1.937 billion, with 47.22 million shares outstanding. The company sees a 10-day average trading volume of 0.05 million shares, indicating its liquidity in the market. Moreover, DKL has delivered a dividend of $4.20 per share, translating to an impressive 10.25% dividend yield based on its current stock price. What sets DKL apart is its stable cash flow. They've secured long-term contracts with major industry players, ensuring a steady stream of revenue that supports their generous dividend payouts. This reliability is gold for investors who value consistent income. By including DKL in your investment mix, you're not only tapping into a vital part of the energy market, but also adding a reliable income stream to your portfolio. It's a smart move for anyone looking to balance their investments with a sturdy performer in the robust energy sector, offering both stability and substantial dividends. Number 3. Creative Technology Limited. Creative Technology Limited, based in Singapore, specializes in digital entertainment products ranging from audio solutions and wire speakers to headphones and portable media devices. One of its standout innovations is Super X-Fi, which recreates a multi-speaker studio experience through computational audio techniques tailored to each listener's unique head and ear profile. The company's diverse product lineups include Sound Blaster for sound cards and gaming peripherals, a variety of speaker types from computer to portable, and a range of headphones from wireless to in-ear options. This broad spectrum of offerings caters to professional and consumer markets, leveraging cutting-edge technology to enhance audio experiences across different devices. In financial terms, Creative Technology Limited boasts a market capitalization of approximately $69.41 million, with 70.4 million shares outstanding. Its strategic focus on digital entertainment positions it well in the post-pandemic landscape, especially with a dividend yield of 9.17%. This yield is particularly appealing as it aligns with the recovery in the retail sector, where increased consumer spending could drive further growth. Moreover, Creative Technology Limited's portfolio includes retail and office properties strategically acquired and managed for long-term growth. This diversification spreads risk across different asset types and geographically across various regions in the United States, reducing market-specific vulnerabilities. For growth-oriented investors, Creative Technology Limited presents a compelling opportunity. It combines steady dividend income with the potential for capital appreciation over time, making it a strategic addition to any diversified portfolio focused on income and growth. Number 2. Matamed. Matamed Berhad, a Malaysian-based investment holding company, primarily manages plantations, holds properties, and cultivates durians. The company oversees a diverse portfolio that includes managing oil palm plantations from seed procurements to field maintenance, selling fresh fruit bunches, FFB, and holding industrial properties like the Larkin investment property in Johor Bahru. Additionally, through its subsidiary Matamed Agriculture and Plantation, Segamat, SDN BHD, MAP, Matamed owns vacant freehold land earmarked for future development. With a market capitalization of approximately $43.13 million and 2,389.2 million shares outstanding, Matamed's operational activities are significant in Malaysia's agricultural and property sectors. However, it does not offer a dividend, resulting in a nominal dividend yield of 1.88%. This financial profile reflects its focus on reinvesting in its operations and growth, rather than distributing profits to shareholders. In contrast, Mitapa or Med represents a consumer-based company with a compelling presence in the health and wellness sector. Specializing in weight management and nutrition products, Mitapa boasts an impressive dividend yield of 99.89%. This high yield underscores strong consumer demand and effective business strategies, ensuring consistent dividend payments. Mitapa's inclusion in a diversified portfolio not only taps into the wellness industry's growth, but also aligns with global trends toward health-conscious consumer behavior. While Matamed Berhad focuses on agricultural and property holdings in Malaysia, Mitapa presents a stark contrast in the health and wellness sector with its robust dividend yield and strategic market position. Investors seeking exposure to different industries can benefit from both companies' unique contributions to a diversified investment portfolio. Number 1. Van Eck Mortgage. Now, consider investing in the Van Eck Mortgage REIT Income ETF, MORT. This ETF stands out because it offers a hefty 13.56% dividend yield. That means for every dollar you invest, you're getting back a chunk of change in dividends. What makes MORT interesting is its focus on mortgages. Mortgage companies tend to do well when interest rates are steady or dropping. So MORT adds a layer of diversity to your portfolio by including these financial tools. MORT offers a solid income stream for investors looking to balance their portfolios with a mix of assets. Those regular dividends can add up, which is great if you're aiming for steady cash flow week after week. So MORT isn't just about numbers and percentages, it's about adding stability and income to your investment strategy. Whether you're new to investing or a seasoned pro, having an ETF like MORT in your portfolio can help you meet your financial goals by providing a reliable return. So, which of these options seems to be fitting to your portfolio? Share with us in the comment section below, and don't forget to subscribe to the channel before leaving. See you in the next video.